The shilling has lost some good ground against the dollar. And of course, there are several factors that are being advanced for this state of affairs. And many are looking at the weak export docket as one of the reasons behind this scenario. Today, we delve into much more of the reasons that are responsible for the weaker local unit against major international currencies.
The announcement by the central bank last week to increase its benchmark rate, CBR, from 9% to 10% cannot be divorced from the weakening of the shilling against the dollar. With the local currency trading close to 4,000 shillings to a dollar, this means that Ugandans today need more shillings to import the things they use in day-to-day life. This has already sparked inflationary pressure, a signal that the central bank seems to be reading Uganda's economy being an import-dependent one.
When you look at the numbers, our imports far exceed our exports. And we are now, at the end of June, we're talking about 2.5 billion. About this time of the year, we see quite a bit of import demand for the festive season. That puts a bit of pressure on the currency as well.
Global events like the rise in oil prices, with some experts pointing out that it will touch $100 a barrel by close of the year, have not helped the shilling, and the adverse effects are being felt in the economy.
All of 2017, 2018, the dollar, reversing its downward trend and strengthening. So by now, I think the last numbers I saw, about 4% the strength of the dollar against major currencies. That's huge. That has an impact on emerging market currencies, and frontier markets, including Uganda. Coupled with that, the U.S. Fed has been tightening. Interest rates are on the up in the U.S. Economy, basically in reflection of the strong and U.S. economy being in shape. So that also, of course, has an impact, given that as interest rates go up in the U.S., we see sort of reversal going into the U.S. market. So portfolio flows will not be as quick to come to markets like Uganda.
According to experts, the government needs to swiftly counter the rising balance of trade deficits with an increase in exports.
Every time you sell outside, you get the dollar. But the challenge that we have is that most of the things that we are using, even in industry, raw material, equipment, inputs, agro-inputs, everything is being imported from South Africa, from wherever. Every time we go out to import, we spend dollars that we are not earning. And every time you spend dollars and you are not earning as much, so you spend to get inputs and raw materials and so on, but when you produce, you don't add as much value to be able to pick the foreign currency.
From the services subsector, there is also a push to leverage tourism and the country's labor force to boost the country's export earnings.
That as long as our export base remains narrow, and as long as we don't have as many people out there, working, earning money, and remitting back here, as long as we don't develop our tourism industry, because these are the major exports that we can be able to pick for foreign currency from, as long as those remain unattended, it is very difficult to defend our shilling.
At this point, economy observers are advising businesses, especially SMEs, on the way they contract debt.
If you're a company, an SME, try to avoid dollar debt, loans that are denominated in dollars. If you have to, and if your business is dollar intensive, use hedging instruments. Hedge against your exposure by basically doing swaps and transactions that you lock in a rate so that you mitigate against the risks.
It is clear that almost all odds are against the shilling at this point in the time, some of which are staying beyond our control, like oil prices and an attractive American market. But for those we can do, like encouraging domestic production and value addition for import substitution, there is consensus that we should do them.